All right, what is up, my peeps? Joshua Smith here with another GSD Mode podcast. And today I wanted to jam with you on just an overall state of the economy, overall state of the real estate market, and just share some things with you that I am seeing, that I am paying attention to behind the scenes, that I very rarely, if ever, see or hear talked about inside of our industry. So whether it be on YouTube or other podcasts or on the mainstream media, just things that I don't hear discussed, that I don't hear others talking about, and just things that I think that are really important for us to pay attention to so we can plan accordingly when it comes to growing and scaling our real estate businesses. You know, one thing that becomes imperative, if you want to have that ability to grow and scale your real estate business, whether you're a realtor, team leader, or brokerage owner, but if you want to continue to grow, scale, and thrive year after year consistently and continue steady income regardless of the market, you have to have the ability to go out there and read markets and anticipate where those opportunities are at. So with that being said, the first thing that I want to say here is, look, I'm going to go through some things here that sound, that not just sound, that are unpleasant, that may not, sound great, that may sound a little bit depressing. But I don't want this to be, I'm not here with intent of making this about fear porn. I'm not here to get you down or get you discouraged. The reality is this, is that the market itself has nothing to do with our overall success. The market does not dictate our success. You and you alone, we as real estate professionals, dictate our own success. And we've got to get really good at the ability to navigate and operate well in any single real estate market climate that we're experiencing. So it doesn't matter what the economy's doing, doesn't matter if we're in a boom or a bust, recession or a strong economy, doesn't matter if the real estate market is going up, down, sideways, anything in between. Transactions are always taking place. There's always opportunity. And this is what I mentioned just a moment ago, in our ability to go out there and read markets and go out there and adapt, pivot accordingly to ensure that we are thriving, because there's massive opportunities. Real estate's always trading hands, always has, always will. So it's no such thing as a good market, no such thing as a bad market. The real estate market's always great for somebody. It's our job as real estate professionals to identify whom the market is good for, meaning where those current opportunities are at. So I wanted to lead with that because I don't want this to come across as negative. I don't want this to come across as, again, depressing or, oh, Chicken Little, sky is falling. But the reality is, guys, is the data just does not look good. Now, that does not mean that the real estate market's going to crash. I'm not here to say if it's going to crash, go up, go down. At the end of the day, I don't know, you don't know, we don't have a crystal ball. There's so many complexities behind the scenes right now that I don't believe that anybody truly knows. There's a lot of people that think they know. There's a lot of people making content that say it's going to go, boom or crash, right? You got the bulls versus bears out there. A lot of people coming out there creating content with their full certainty that the market's going to do this. Oh, it's going to continue going up. There's no way it's going to crash. Then you got people like, oh, it's going to crash. At the end of the day, nobody fucking knows, right? Like, we don't know. You don't know. I don't know. Nobody knows. I don't know if there's a human being on planet Earth right now that knows. Again, there's so many complex things that are taking place domestically as well as on a global level right now. Things that have never taken place in our lifetimes, things that have never taken place anywhere in recorded history that I can find. As an example, the deglobalization that we're experiencing, the extreme population drop-off, decline that we are experiencing globally. So there's just things that there's too many moving pieces and too many things to know exactly what is going to take place for sure. And at the end of the day, like I said, it doesn't matter whether the market's going up, going down, going sideways. It's up to us to go out there and create success with these opportunities. So I'm just speaking to how things look right now, and again, where there can be opportunities at right now. Okay, so before I jump into this data here, one thing that I think is really important to know, something that you may not understand or know yet, but if you study data historically. I mean, I'm a data freak. I love to get into data and this stuff. Just, I'm a total geek. I'm a total nerd. So this is what I do on my, off time, is just studying data and studying history, and so forth. Now, we get reported a lot of data. So let's just say unemployment data. Job reports data, unemployment data, even GDP, data metrics of what's taking place. Well, it's important to note and understand that this data gets revised. If you okay, let's just look at the great financial crisis as an example. The data that was getting reported live time up to the point of the great financial crisis, and even as it was taking place, was revised 3 years after the fact and revised where it was much uglier than what was being reported to us. So if you look at last year in 2022, we were delivered certain job report data. What just came out with their revisions just now, like just like a week ago, where they're like, oh, whoops, we overcounted jobs by 8. I think it was, I'm trying to go off memory here. So you can go out there and Google this. I might be slightly off on this, but I believe it was like they missed their reporting by 816,000 jobs. Oh, there's actually 816,000 less jobs than we thought on that data. And we just saw this recently with COVID. Man, it came out after the fact of, hey, remember that ticker that you were seeing, on your TV every single day of the deaths? Well, we believe that we overcounted that by over 30%. And, they've come out and admitted that now and went back and revised the data. And I'm not saying that they're doing anything nefarious or anything wrong here with this stuff. Maybe they're not. I have no way of knowing. I think that we're in the thick of things. We got a lot of data that's being reported. Then when we able to do a deeper dive and have more data available to us, with some of this stuff, we realized that maybe that data was wrong or got reported to us wrong. So again, I'm not here to say whether it's good, bad. I'm just saying that what gets reported to us live time isn't always the true data that is taking place. All right, so I want to bring that up first, all right, because the first thing that I'm going to go into is unemployment data. Now, when it comes to data and it comes to statistics, one thing that I like to look at is because these models are always changing. Things are always being reported. A lot of times the data, the information that we get delivered to us is to get us to act and think in a certain way. And if you think as the government as a big business, this is the way I always look, mentally frame it. Thinking of the government as a big business, right? So then from there, okay, if you were the CEO of a big business and maybe your business wasn't doing very well, okay, you're probably not going to call a meeting with all your employees, all hands on deck, and come out there in that meeting as the leader of your company and be like, oh man, you guys, like, we're in a tough spot. Like we're in a bad spot, man. I got 2 weeks of payroll left in the bank. Like if we don't get things turned around, we're going to be screwed. We're going to be insolvent. Like, you're not going to go out there and deliver that news, right? Because why? All your employees are going to go out there and start job hunting, and they're not going to do what you need them to do, right? You're probably going to go out there and sell the vision, sell the dream, get everybody riled up because you need everybody giving everything they got to turn that negative scenario around. Okay, well, if the economy is going to shit and in free fall, which is what I believe that we are in right now, a free fall, just shit economy, if they came out and just were like, all right, guys, like shit is ugly, shit is bad, and it's going to continue getting worse, well, then from there, what are people going to do? They're going to contract. They're going to retract. Consumer sentiment is going to go down. People are going to stop spending money. There is not going to be no soft landing. It's going to be a hard as hell landing, right? So these numbers, how they get calculated are always changing. So when we hear certain things like inflation, inflation is as high as it's ever been since, 1979 or whatever they're, telling us that date is. Well, the only way to accurately make that comparison is if those things were calculated in the same way. So if you look at unemployment today, the way that they model unemployment and the way that they track unemployment has just greatly been altered over time. So if we look at this today, when I say true unemployment, and I'm not saying that their models are wrong, I'm just saying if we want to get into a perspective of how things truly are and how the economy is today versus historic times in the past, like the Great Depression as an example, well, we would need to plug in our current scenario into those same models. Right? So if we look at true unemployment today, true unemployment is just above 25%. So we are at for unemployment levels, if it was calculated the same way as it was during the Great Depression, same way it was during the 70s and 80s with that, decade of stagnated growth and stagflation, 87 crash. A lot of these models got changed and altered with how they calculate CPI and how they calculate all these models, during the Clinton administration. So if we calculated unemployment today the same way that we did, during the Great Depression and whatnot, we would be at Great Depression numbers when it comes to unemployment. So true unemployment right now, because we are record low number of job participation rates, record number of those that are classified as unemployable, because now they drop off quicker, and then when we just look at payroll reports. So you got true unemployment today. Again, if we look at this the same way as it's been calculated in the past. So we're talking 25% true unemployment. And when I say true, that is me stating that, and I've already went into that, as to why I call that. So, but then from there, when we're getting these payroll numbers, what I want you to understand with these payroll numbers is when they're like, okay, well, payrolls are growing. What we are experiencing right now is a record number of white collar layoffs. So we're experiencing shrinking work weeks. So this means that like a lot of manufacturing, a lot of industry right now, what's taking place is, okay, instead of offering overtime or even 40 hours a week, they're starting to shrink that down to 30 hours a week or 35 hours a week, right? So we got a record number of layoffs in white collar jobs and a record number of kind of hour shrinkage, if you will, in that type of sector as well. So the good jobs, right? The good jobs are going away and starting to shrink. So what we are seeing right now, because when they're counting, when you look at just payroll numbers, when let's just say somebody loses a job where they're making 150 grand a year, and they have to go replace that job now with 3 part-time jobs. Maybe they got 1 full-time service job, and then they're driving Uber, and then they're freaking doing DoorDash or something, whatever that may be. So they got 3 different jobs, right? To make up for that $150,000 a year white collar full salary job. Well, the payroll numbers look at that as, okay, we have 1 job loss, but then now we have 3 payrolls that have been added, 3 new jobs. So that's a net gain of 2 jobs. So we're seeing a record number of part-time workers and record number in these lower kind of, salary style jobs. So, those numbers get kind of skewed and it's not that full picture. All right. So that's what's going on with unemployment right now. So people are making less money, not making more. All right. So then if we look at, according to the Wall Street Journal, we had a record rate of homelessness. If we look at 2022 to 2023, it spiked by 11%. So the previous largest year since 2007 was a 2.7% year over year increase. So, and that was actually in 2019. So, the biggest, since 2007, the biggest increase in homelessness that we've seen was 2.7% year over year of a jump. We just jumped over 11% between 2022 and 2023. That was bigger than any time during the Great Financial Crisis, bigger than any time during COVID with people losing their jobs and, all of that taking place during that time frame. So 11% increase, which is just astronomical. And we're seeing it. One thing that I always recommend to do is, turn off the news. And just go out there and be involved in your community. Start having conversations with people in your community, asking how they're doing, find out how they're doing. Like just paying attention to real life. Because sometimes what we see on a screen or on the news doesn't really reflect what is actually taking place in our communities, right? All right, so we got, a record number of homeless, people going homeless, people getting on the streets and losing everything. All right, so then if we look at U.S. debt, right? So we just exceeded $17 trillion in United States consumer debt. Now we are at all-time record levels of debt on all fronts at magnitudes of scales never seen before. And this isn't just a U.S. problem or a domestic problem. This is also a global problem. But we look at corporate debt, you look at government debt, you look at the Federal Reserve balance sheet, right, which would be considered, corporate debt, if you will. And then when we look at consumer debt. So on all fronts, debt is a massive issue, and there's this massive debt crisis, debt bubble, that's been brewing for a long time. And I don't know how this is necessarily going to be managed, but let's just look at the consumer debt. So consumer debt has now exceeded 17 trillion, so the highest ever to ever exist. And then even if you back out, because a lot of times when we talk about debt, a lot of people think, well, yeah, but mortgages, most of that's on mortgages, and mortgages have went up, so that would make sense. No, if we even back out mortgages on this, we got record high credit card debt, record high auto loan debt, record high student loan debt, record high medical debt. And when we think about, student loan debt, right, we've had there's $1.7 trillion in student loan debt here nationwide. Over $1 trillion of that has not been collected since COVID, right? It's been in this moratorium status. Well, starting in October, that's going to start coming due. Like, how does that impact our economy, people's ability to go out there and afford real estate, maintain real estate, buy real estate, acquire real estate, and that's what I'm looking at, all of these things, right? Like, I want to pay attention to see, okay, well, what are these lead indicators for on how this could potentially shift the market? And maybe that doesn't shift in, home prices. Like, I'm not saying that these things that are taking place here will be significant enough to, just crash the real estate market. But today, because of these things I'm sure going to be sharing with you here, my strategy has greatly shifted in the last 12 months of how I go after business right now, where people need my services as far as being able to deliver real estate services to them. So we just had a 17.5% year-over-year increase in consumer debt, which is amongst the largest year-over-year consumer debt increase in recorded on record. You got now savings hitting record all-time lows when it comes to savings. So what does that mean? That means the consumer's tapped out. People are they're maxed on their credit cards. They're doing everything they can just to make minimum payments. They've exhausted all of their savings, right? And we're talking about the masses. We're talking about the averages. Well, the masses and the averages own the vast majority of real estate that's out there. Again, how does this, impact their ability to buy, their ability to sell, their ability to maintain the real estate that they have as well? All right, so we got 2.8% of all mortgages in the United States currently in default status, right? So that means the 30 plus days delinquent. So there's 84 million mortgage holders, just over 84 million total mortgages throughout the United States, over 11 million HELOCs in addition to that. And 2.8% of those of the actual mortgages, not speaking HELOCs, but 2.8% of those are 30 days plus in default status. So that breaks down to 2,352,000 homes right now in 30 plus day default status. I don't know if they'll come clean. I don't know if they will be able to figure that out, if they'll be able, sell beforehand. But that's potentially, 2.3 million, properties to, hit the market or are going to go back to the bank, with that. Now, if we look at commercial real estate, commercial multifamily, the default rates are slightly above that at 3%. Now, a lot of these are going to reset. I know that you've been hearing about that. A lot of them have to restructure that debt and reset that debt here the next couple years. I think I can't remember what the number is on that, but it's pretty large of the amount that needs to be restructured. So we'll see if that rises, not rises, how that shakes out, but wanted to drop that stat as well. Okay, so now today, we have 25,000 daily auto repos every single day here in the United States right now. And that's up about 10,000 from a year ago. About a year ago, probably heard me talk about this on this podcast if you're a longtime listener of this, we were at 15,000, which was already a record high. So at 15,000 daily auto repos every single day. Now we are at 25,000. So this is greatly growing. A lot of people will talk about, economy's fine, real estate's fine because mortgages are done differently today. Look, the subprime and all the fraud that we saw taking place in the real estate sector, that led to the, one of the reasons that led to the great financial crisis has been taking place in the auto loan industry over the last several years, right? Which is one of the reasons, like people were able to count their stimulus and, or additional income they were getting through the COVID for auto loan debt. So there's a lot of fraud, and it wasn't technically fraud. It was allowed, right? So, but it was, reckless, I should say, instead of fraudulent loans. But to the point where these banks are not taking these auto loans because it's at such a massive scale. They are not taking these to auction because when they have to take these to auction, they have to realize those losses on their balance sheets, right? And they are extremely scared right now, extremely nervous that would put them into a liquidity crisis. Because what took place during the great financial crisis was a liquidity crisis. Now, it might have been the mortgage industry that, at that time on real estate mortgage industry that broke the straw of the camel's back and put the banks in that liquidity crisis. This time around, man, who knows? Could it be auto loans? Could it be the commercial real estate market? Could it be, when we go into economic turmoil, a lot of times it's different things that lead to that turmoil. It's not always the same thing, that leads to that. So, things I'm just paying attention to. All right, you got 1.3 million single family, I shouldn't say single family detached. You got 1.3 million short-term vacation rentals out there. So your Airbnbs, right? Your STRs, right? Your short-term rentals out there. 1.3 million nationwide. About half of those were acquired since COVID. So this became a big fad thing. Now, if you look at between 2020 and 2022, as far as STRs, right? So your short-term rentals, average occupancy rate was 70% on a nationwide scale. Now, market to market, this can be different. So I'm speaking of nationwide numbers here. So just think of this. Okay, so they were used to having 70% occupancy rates. And remember, half of these, so 650,000 of these were acquired since COVID. Became this big fad thing. Everybody was jumping on these. There's 1.3 million of these today. 70% occupancy rates were the average between 2020 and through 2022. Now here in 2023, average occupancy rate nationwide is 56.4%. So we look at that, occupancy rates have dropped. I mean, you start doing the math on that, well, that's about 14%. So cash flow has dropped about 14%, on those. So in certain markets, now if you're somebody like me that is going after this niche as a way to go out there and get listings, conversation after conversation after conversation with them losing money hand over fist, that's why they're needing to go out there and sell. That's why I say it's important to be able to decipher this stuff and look at this stuff where we can see where those opportunities are at. Yeah, I know we've got a shortage of inventory hitting in the market or on the market currently, but, and I'm not saying all 1.3 million of these are going to end up, on the market, but it doesn't take a lot to start impacting, the overall market. All right. So then now that's short-term rentals. Then if we look at long-term rentals, so your long-term buy and holds, we are now experiencing cap rate compression in the majority of markets that we haven't experienced in about 15 plus years. So by cap rate compression, I mean, you got 57 of the top 100 metros throughout the United States right now, where you have rents going down. So as an example, my market here in Phoenix, Arizona, rental collections, rent rates are down 6% year over year. So if you have these investors, let's say this investor that had this single family attached property, was collecting rent on it, was getting a 10% cap rate. Well, it's down 6%. So that cap rate went from 10% down to 6%, right? But then what do we have? We got increased taxes. We got increased insurance. You got increased, HOAs. You got increased, cost of maintenance and labor, all those things. So they might have been at a 10% cap rate a year ago or 18 months ago, and then now all of a sudden they're down to a 2% cap rate. Right. And then if this continues, which all the signs are showing that it's going to continue, you got about 1.8 million rental units between multifamily and whatnot in the new construction pipeline that are due to be delivered to the market within the next year. So as this continues, because we got evictions just going through the roof, evictions just going through the rise all throughout the country, in most markets, not all, but in most, right? Like if I look at my market, evictions are up 121% from pre-pandemic levels. So just last month, we've had 7,142 evictions. These are on the tenant side, not on the I already talked about, notice of defaults there on the mortgage side, but it's a lead indicator of again, what's going to take place with investor clients. But then also I look at that of, okay, it's a lead indicator of what's just going on with the consumer, right? So again, creates a great opportunity to go out there. You got investors where if they want to be able to unload properties right now at or close to all-time high pricing. Because what do we have right now going on, man? We got the most unaffordable that real estate's ever been in recorded history, right? Then when we stack onto inflation with that, because we got real estate inflation, but then we have life inflation. So whether you want to look at inflation, appreciation, same word, different words for the same damn thing. But then if we take real estate out of it, life itself, it's the most expensive time to ever operate as a human being in United States history. Life today is about 40% more expensive than it was 3 short years ago. So it's putting the squeeze, man. Like you're just seeing the average person getting crushed. Not just the average middle class. I mean, you got the average middle class, lower, middle class, obviously poor, that it's crushing, but you're starting it to see it deliver pain also to upper middle class and the affluent. So people are really, really starting to feel this pain. I mean, if you're in the top, maybe 5%, maybe even take beyond that, for you to not be feeling this pain of income earners. But we're seeing a ton of people feel this pain. And again, I don't, when I say I'm not as optimistic as most about where this economy, where this housing market is going, I'm just watching what's going on. I'm looking at these KPIs where I see people getting racked with debt, savings going away. And this whole inflation thing, this isn't stopping. This isn't slowing down. I mean, true inflation today, and when I say true inflation, I mean, if we calculate it off the same models that have been used, historically since this stuff was calculated, inflation today, I mean, they're saying that, it's down to like 3.5% or whatever that target is. Nah, dude, it's kind of more like, 8%, right now, based on those models. But again, if we calculate this and break this down, it's easily 40% more expensive today than it was just 3 short years ago. And when we're looking at just with everything taking place, right? When I'll explain more of this here in a minute as to why more likely than not, inflation on the essentials is going to continue. Now, you might see some of your electronics go down, for the bullshit that we don't need to operate life go down, just because China's going through, some deflationary, times with their economy. So yeah, you might see some widgets going down, but essentials, when I say essentials, I'm talking about the shit that we need to operate life. Our utility payments, gasoline, food, shit that we really need in our life, going to more than likely see inflation on these for years and years and years to come. So this just, okay, if this continues in life, like people are already getting so crushed, right? When we're seeing debt go up every single month, savings go down, like, okay, unless there's a big correction where all of a sudden life magically becomes more affordable, okay, that gap's going to get wider and wider and wider. People are going to lose more and more bankruptcies, more foreclosures, more, or having to fire sell their house, shouldn't say free. I mean, some, anybody, at least in my market, anybody that's bought like since 2021 is going to have to go out there in their short sale or foreclose for the most part, right? So, that there will be a percentage of those to come, that we're already starting to see, definitely on the short sell front. Again, I'm not saying that this is going to be enough to make it enough supply to crash the housing market. That's not what I'm speaking about here. I'm just speaking that, hey man, there's a big percentage of families right now just getting murdered and getting crushed, with this current economy. All right, so talked about cap rate compression there. All right, so, why do I think, well, let me share one more stat with you, and then I want to talk to you about 3 ways that GDP is grown and what we're seeing here. All right, so then when it comes to another hardship, so last thing I have written down here is right now, this year, so for Americans, hardship withdrawals. So if you're investing in a 401k, right, you can do what's called a hardship withdrawal. So if you can show the bank that you're experiencing a hardship, okay, you can withdraw some of those funds, and I don't know exactly how it's structured, but it might have to be paid back at some point, but like you can maybe withdraw without some penalties or whatnot there. Never had to do it personally, so I don't know all the ins and outs of it, but I'm somewhat familiar with it just because I offer 401ks and several of my companies to my employees. But anyway, with this hardship withdrawals, now again, you have to prove, though, that you are experiencing a hardship in your life to be able to participate in this. But hardship withdrawals on 401ks are up 36% in the last 12 months. So again, indicators that the average person is just getting crushed. All right, then, so when we look at this, all right, so when we look at 3 different ways to grow GDP. So a GDP, okay, if you have good, positive GDP growth, that means the economy is good. That means it's growing. We're being told it's good and it's growing right now, but like, whom's it good for, right? Like, anyway, with this, so there's only 3 ways that GDP either grows, or we're going to go into a recession or depression. And this is why, and I'll get into this here in a moment, but this is why, there's a lot of brilliant minds out there that are calling this right now that we are in the silent depression. And I'll explain more on that here in a moment. All right, so the 3 different ways for GDP growth. Number 1 is population, right? So as you have more and more population growth, you got more people being born, more people, consuming, more people working, all of those things. So for all of our lifetimes, we had positive population growth, right? So now for the first time, we've crossed that intersection where now we're having negative population growth on a global scale. And it's ugly. It's not like this isn't just waning slowly. Like this is on a freaking falling off of a cliff, like, on a massive scale. So it sounds kind of funky, but it's true. Human beings now qualify for the endangered species list. So if you look at China as an example, China is now the fastest aging civilization in recorded history. They have twice the number of 15-year-olds than they do 5-year-olds. They got more 85-year-olds than they do 75-year-olds, and they do 65-year-olds, and they do, so if you were to think about a healthy population, healthy demography, think of it as a pyramid. Right, so you got, young kids and, at the bottom, and then you got, the oldest at the top, right? So it's like you got more younger people than you do older people. Well, the whole entire globe now is an inverted pyramid, right? So you got more old people than you do young people, and we're way beyond replacement. So this is beyond correctability at this point. Now, when we look at the United States has the healthiest demography of any advanced industrialized country in the United States. But ours isn't that great either. It's the healthiest out of everybody else's, but it's because everybody else is so damn sick. So as an example here in the United States, so when I see this, when people are talking about this overall supply and demand issue, I'm like, show me how that exists. Right now, I get that there is currently a lower supply of homes. There's a lack of supply that are currently active on the market. But when you look at, I'm talking about number of housing units versus our population, like it's just not like there isn't an actual shortage, right? When you're looking at it that way, at least I'm open to being wrong. I'm okay with that. Like I'm not, I don't operate from an ego. I'm okay with being wrong. Just show me the evidence and the data that supports it. Because I studied this stuff very heavily and I see zero. All right. So when we look at population, in order to replace ourselves, the average couple needs to have 2.16 children. And it's 2.16 versus 2, just because unfortunately not everybody makes it, right? And every kid makes it. So I need to have just for replacement population, 2.16. We are currently at 1.66. And we're the healthiest demography out there, right? At 1.66, as far as an advanced industrialized, country. There's other countries that, have growing populations, but third world countries and whatnot, right? So when we start looking at that, so 3 different ways to grow GDP. Number one, population growth. That's out the window. We are shrinking with population because with population, it's not just how many people are having babies. It's also with immigration, but both of those are on the decline. Okay, so number 2 is productivity, average productivity per worker. We're experiencing the lowest productivity per worker in United States recorded history since this has been recorded. So that is out the window as well. Now that might change with AI and freaking robots and shit, but that's going to take decades, right? We got, 2 of the 3 that are completely out the window, that ship has sailed, for GDP growth. So now we're left to just the third. And this has been what has been taking place since 2008, 2007-ish, 2008. And this is why, we're kind of in a silent depression, if you will, which is debt, right? So this is public and private debt. So when we look at this, and this is what's been going on again since 2008. So we had 16 years of this artificial economy where all of this is, all of our GDP and all this positive economic growth is just made up through debt, public and private sector debt. And you start looking at this, if you look at the Federal Reserve, their balance sheet prior to the great financial crisis was about 700, maybe I think 800 billion. Now today it's like 10 trillion, right? Look at the government's debt. Yeah, right? I mean, just watch it. Just go check out U.S. debt clock and just watch that bitch grow. Oh, it's scary, watching that debt grow. So this is what is taking place right now is just debt, right? So if they don't want to have the economy go into a deep recession or a depression or a free fall, the only way to keep this thing propped up, which they've been doing since 2008, like all this that we experienced, even after the great financial crisis, everybody's like, oh, it's such a great economy. It was artificial, right? And that's what's led to us now, life being 40% more expensive than it was just 3 short years ago, right? You had 40% essentially of all dollars to ever be printed in U.S. existence, in U.S. history since 1776, were printed in the last 3 years, right? So then, when you're taking money out of the future, pulling into the now, creates inflation, and it's just kind of odd, isn't it? That life is 40% more expensive today. Real estate's roughly 40% more expensive today. Yeah, right. They also printed 40% of all dollars to ever exist. So when they sit there and say, oh, well, quantitative easing money printing doesn't create inflation. Okay, show me how it doesn't, right? Like we're seeing it right now. We're living it. You can tell me all that you want to tell me. You can go out there and speak all the bullshit you want to speak. You can tell me it's safe and effective, right? Like, tell me what, but I want to see the data. Like, show me, like, and not just the data, like, I can also see this shit. I can go to the grocery store. I can go, and see how this is impacting life. But with that, okay, what are they doing right now? They are doing everything they can to manufacture what they're calling this soft landing. So all they're doing right now is expanding balance sheet. So creating more debt. So as I said earlier, as to where I believe that we're just going to continue seeing ongoing inflation. We're financing freaking wars. We're financing all this bullshit. The government's running a $2 trillion plus deficit every single year. So it's just, they're just monetizing debt. Federal Reserve just continues growing their balance sheet and continues printing money. I know it's not necessarily printing money, but let's just call it what it is and just reduce it down to very simplistic terms. They're just printing money, right? To continue this artificial economy that if we took all of that out, if we took all this artificial, all that money printing and monetization of debt, and we operated is really just kind of, I don't know, an actual capitalistic society with true free capitalism, if you will, we'd be in a 16-year long depression right now. So with that, if they continue this, see, it's one of two paths, right? They either stop that and go be fiscally responsible, and then just let shit crash, all things crash, right? And that would, in my opinion, lead to a real estate market crash, which I'm okay with. Now, you may not be okay with that, but I'm okay with that. I think it's the best thing long-term for a country is to experience a massive deflation on all fronts, right? Like we just, when it comes to this, why do I say that? Well, you got to make the decision at some point of, would you rather have your dollar be stronger, or would you have it rather be worth less? Do you want more purchasing power or less purchasing power? Deflation creates more purchasing power, right? So if I can buy the same house for 200 grand versus 600 grand, okay, well, at 200 grand, I have higher purchasing power with my dollar, makes life more affordable, makes the quality of life for the average American, right? Keeps that American dream alive, right? So, to me, yeah, it would be painful. It would suck, but I'd rather rip that Band-Aid off, and have our purchasing power be more, even though we all go through some pain with that. Right? Or they can continue down the path that they're going on right now, which is the path that they are continuing to go down right now. So, I'm not going to get my wish here, I don't believe, but I believe it's going to eventually lead to the same result, right? So it's just bleeding it out slower versus just rip the Band-Aid off, fast. Let's just get through this. I believe it's going to lead to the same result. I could be wrong on this. I just believe it's going to lead to the same result, right? Because what they're doing right now is just going to continue more and more inflation. It's going to continue to break more and more people. And once that breaking point hits hard enough, okay, it's gonna then end up in that same result, right? Like, okay, if we look at what's the, there's a great economic saying of quickest way to curing high prices is through high prices, right? So eventually, okay, if all these people start losing their homes, because the vast majority of real estate is held by the middle class. Well, if you crush the middle class and they all got to start dumping their homes, right? Well, then it's going to create those fire sales and adjust that affordability. But with all things in life, right? Because it just comes down to supply and demand. Well, if prices break demand, then like, meaning nobody can afford the shit, or nobody can go out there and buy, or they're just refused to buy the shit because it's just just astronomically expensive. Okay, eventually those prices correct themselves and come back down. So, I believe it's going to lead to the same result. It's just how quickly are we going to get there? Right? Do we want to kick the can down the road another 10, 20 years? Maybe. Right? If that's, it's a path that they're going down right now. So we'll see how long this lasts, see how long this goes down. This is where I was saying, because then we stack on top of that, again, this deglobalization that we're experiencing, stack on top of that, potential World War III. Like, who knows where, there's so many other moving pieces. Like, who knows where all this stuff is going. But with this being said is, okay, I'm paying attention to this stuff. I've watched this stuff, and then I see where these opportunities at. Right now, I already talked about opportunities in the investor market. Already talked about, going out, there's big opportunities in the notice of default market. So, and then from there, I'm paying attention to, okay, who can afford to participate in this market? What are the demographics that aren't being impacted, that still can go out there and afford real estate and choose to participate in this market, and I can target them accordingly. And I know I've created a lot of podcasts on that recently, so you can go back and watch those. So this was just more of an overall state, kind of state of the economy, state of the real estate market, where we're at, where things potentially could be headed. But anyway, I hope that this is helpful. I don't know, maybe I just blabbered for 38 minutes here. Maybe this wasn't helpful. But want to share with it because it's shit that I'm always paying attention, I'm looking at, that I just don't see talked about a lot in our industry. But again, don't get down on this stuff. Like, look, I'm a giver. I'm a lover. I hate seeing people hurting. I hate seeing people struggling. So all this shit, man, it can get me down and it can depress me. But when it comes to my own business, when it comes to your own business, none of this needs to mean that you need to struggle. There's so many damn opportunities. I just had my biggest month ever last month in the history of 18 years of me doing this in the real estate business, or over 18 years of doing this. So the biggest month ever amongst all of this shit. My team and I did about $30 million in sales last month. So there's massive opportunities. We just got to pivot, shift, and adapt accordingly to where those opportunities are at. So if you need help pivoting, shifting, and adapting. Make sure to go check out gsdmode.com. Click on that coaching tab. You can learn about my coaching, my mentorship program on there. It's the most effective but most affordable coaching program that exists out there in the industry. So if you want to learn more about it, there's a video on there. You can check that out. You can also schedule a 100% zero pressure discovery call with me. I have a very strict absolute no pressure policy, so I'm not going to try to sell you or hard sell you. We'll just talk. We'll talk about your business, what your goals are, what your obstacles are, talk to you about how the coaching program works, answer any questions that you have, whether the coaching program's for you or not. I'll make sure that call is very beneficial for you. So you go check that out if you want to talk with me personally. Those calls are with me personally. So again, gsdmode.com, click on that coaching tab. All right, guys, hope that this is helpful. Keep crushing, keep kicking ass. I'll see you next time. Peace.